Hello everyone. So we had 7 green days in a row today in the market, and what I did was I went back in history to all of the different bear markets for the S&P 500 for quite some time, and then I looked at all the similarities and differences. So I want to see how damn strong some of these bear market bottoms would be, because I'm assuming that the bounces off of these bear market bottoms would be very, very strong, and I just want to see if in fact there was ever a time where we also had 7 green days in a row. So this video will be a bit different, so I hope you guys enjoy. Make sure to like, comment, subscribe, do all that good stuff, and let's get started. All right, so let's start off. We're gonna go to October of 1957. All right, so let's take a look here. So what we're doing right now is I'm looking for 7 closes in a row. All right, so I found one here in February of 1958 where we have 1, 2, 3, 4, 5, 6, 7, 8 green days in a row. So what I want to see afterward is how much of a pullback we get, what percentage of the move gets, pulled back, and then basically this signals a bottom. So let's just go ahead and look at the fib levels here. All right, so for the sake of looking at this, so we can see that we have, the percentage gains and the percentage losses are going to be pretty irrelevant looking at it from this far back, but the pullback comes back to around the 618% fib, and then from here we start skyrocketing. So this is the news. This is the data for 1958. The next bear market that we're going to look at ends in June of 1962. So we're going to go ahead and put that into the chart as well. All right, so June of 1962 right here was the lower end of the bear market. We ended up bouncing, but there's no instance over here in June where we have over 5 days of green, nothing over here, nothing over here. But then what's interesting is once we look a few months later into January of 1963, we have 7 days, 1, 2, 3, 4, 5, 6, 7, 8, sorry, 8 days where we have green days in a row. And then we end up this, it pulls back the entire move. So this is actually shows extreme bearishness. But then we have another instance right here where we also have 8 days in a row. So we have in March of 1963, we've got 1, 2, 3, 4, 5, 6, 7, 8, and this ends up retesting we can use the fib here. This ends up only retesting the 38.2% fib. So this is worth looking at when we see this extreme strength, and this extreme strength rarely ever happens. So far we've looked at 3 different instances. 2 of them don't make new lows, 1 of them does. Going down the list, October of 1966 is the next bear market. All right, October of 1966, there's nothing where we have more than 5 days in a row here. There's nothing over here where it's more than 6. But then what's interesting is when you look into April of 1967, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 green days in a row over here. And then this is another instance where all of the gains end up giving back over here. All of the gains end up just losing here. Okay, so this is another instance where that occurs. Next, 1970, May of 1970. So remember, May of 1970, we don't have anything above 5 days over here or 6 days over here. Nothing, more conclusive here. But then when you look at August of 1970, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row where we are green, and this ends up holding the fib of the 23.6% fib. And this, when you zoom out, this ended up marking the bottom. So this was another instance where the market just ended up continuing to rise. All right, we're in the mid 70s, baby. We're going to October 1974. All right, so October of 1974, nothing here, nothing here. Let's go to where the fun is. Okay, so I saw 1, 2, 3, 4, 5, 6, 7, 8 days in April of 1975. So when you look at the fib level from here, we end up retesting the 38.2% fib. Okay, and then this ended up skyrocketing afterwards. We did end up pulling back a bit afterwards, but this was you know, after months, so this is not really going to apply as much here. All right, next, August 1982. We're gonna do some disco, and we're gonna look at August of 1982. All right, August of 1982. I think I might be getting my decades wrong, but that's life. Anyway, let's go to April, and this is where we have 1, 2, 3, 4, 5, 6, 7, 8 days in a row. And if we show this fib level here, we barely even touch the 22.6% fib. This marks a low, and then we never come back and retest this for quite some time. So this is a very, very strong move here. All right, let's look at December of 1987, Mike Tyson era. All right, so this is December of 1987, and so far what we're looking at is the strength, the multiple day strength that we're looking at occurs months after the bear market ends. All right, so the next time after that happens, after 1987, is over here. Now this occurred twice. So the first time occurred in July of 1989, where we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row where it's green, and you could see the fib is not going to be anything crazy here. We don't even retest the 22.6% fib. And then the other time is over here in September of 89, where it's 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row. And then this pulls the market back the entire way. So this, you could chalk this up as way too much strength and in need of a pullback. So this initial push to the upside caused a nice move to the upside, but then once we got this extra push, the market needed a bit of a pullback, it seems. Next, October of 1990. So just an honorary mention. This is April of 1990. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days in a row where we're green here. And then what ends up happening is a few months after, we end up giving back all of our gains. So then this, where we end up giving back all of our gains, ends up being the October 1990 low. So then what's interesting here for the October 1990 low is that we don't have any multi-day green days until December of more than 6 or 7 green days until December of 1991. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9 green days in a row here. And we end up pulling back from January 1992 to April. This is pretty far off, but we do technically pull back to the 6.8% fib. So this is not as conclusive of data, but it does show that there is a bit of a pullback. But then in general, this leads to a completely new highs. Now we're coming to a bit of the modern era in the past 2 decades, post 2000. So we're getting to October of 2002. For October of 2002, there's nothing nearby until March of 2003, where we have 1, 2, 3, 4, 5, 6, 7, 8 green days in a row. And then shortly thereafter, we have a retest to at least a 50% fib. And yeah, so we retest the 50% fib here. And then we're going to take a look at March 2009. All right, guys, so this is March of 2009. And what's very interesting here is there are no days in 2009, 2010, or even in 2011 where we have more than 6 green days in a row. But that did mark the bottom regardless. It just happened without more than 6 green days in a row, which is very interesting. So we didn't have that at all. Next, let's take a look at March of 2020. I'm almost, I could be wrong. Let's go ahead and check that out. All right, next, we're almost done. So COVID crash. We didn't get any multi-day, more than 6 days in a row until October of 2021. So let's go ahead and go to October 21. There it is. Okay, so you can see we have 1, 2, 3, 4, 5, 6, 7 days in a row. And then where did we end up pulling back to? Not even this 22% fib. So this ends up being pretty strong as well. We don't get a pullback. We end up making new highs over here. And then, of course, last but not least, after October of 2022, this is currently where we are now. The next place where we had this many green days in a row. So this begs the question, after checking out all of this data, the vast majority of times, this signaled that the bear market was over. And that is pretty interesting, to be honest. Just looking at that data, all of the times that this happened ended up signaling the end of the bear market and the beginning of a new bull market with new highs. The only time where we ended up completely capitulating after. So every time that we did make completely new lows, right? Those still ended up leading to new highs. So the fact that there was this much strength in the market and we end up falling a bit afterward and pulling back, that still ended up leading to more strength. So I'm going to do a more deeper dive in that data, but the other time was back in 1987, where we had multiple months within that same year where we ended up having multiple 7-8 days in a row. So that ended up causing way too much overextension. And then we had a major pullback into the October 1990. The October 1990 bear market. So yeah, what this is basically leading to, this is crazy strength. And just overall, the overall horizon over the next year, based off of this data, is really, really bullish. And it's pretty crazy. You would think that after this much overextension to the upside, the longer term horizon would be negative. But based off of that data, based off of just quickly looking at the past bear markets, and in comparison how many positive days that we get like this, it's very rare that we have a bear market after this. So this is not the time that occurs, which is, this is pretty crazy. So yeah, that's not to say that we're going to not get any like pullbacks if we just look at the fib levels here. We did see multiple times in history where we didn't get a retest at 22.6% fib, but the vast majority of the times we did break into the 22.6 and end up retesting the 38, the 618% fib. So 424, 420, and 420. This entire zone can still be on the table here. So that is still important to look at. But damn, this 7 days in a row is really, really strong. So yeah. So before we go into the details of the S&P, let's go ahead and take a look at the large tech stocks. Starting off with Apple. Apple clearly had a lot of strength. You can see the slower MACD level starting to curl upwards. This generally is really bullish for Apple. And this is the same case on all of these tech stocks as well. So Nvidia is still hugging this uptrend level. It needs to break above it. So tomorrow the level for Nvidia is 461. So we need to see if it can break above 461. The MACD is doing what it needs to do to continue. The other AI related stock, Microsoft, is doing, this is just ridiculous. This is ridiculous strength here out of Microsoft. You wouldn't think to go long when it's this overextended, but it just continues to go up. This is really, really strong and overextended. This is just historical strength out of Microsoft. Let's take a look at Google. Not so much historical strength, and it's still filling this gap though, which is also pretty insane. So Google is continuing to go up, Nvidia is continuing to go up, Microsoft is continuing to go up, AMD also very, very strong. It's up over 21% in the past 5 trading days, in the past 7 days, sorry. And then when you take a look at Amazon is up over 21% as well. So this is clear cut ridiculous strength out of the large tech stocks. And last but not least, let's take a look at Tesla. Tesla is holding support. So a lot of these stocks are getting overextended to the upside, and then stocks like Tesla are holding support. Meta is moving upwards as well, and then Google is also kind of holding support. So this is crazy. So what's interesting now is we take a look at the VIX. All right, so the VIX has an inverse relationship to the market. If the VIX is falling, then that is very good for the overall market. And right now you can see that the lower Bollinger Band of the VIX is pointed lower, which means that there's still more room to go to the downside. The MACD is starting to move upwards, even though the VIX is falling, which is really, really bearish for the VIX. So if there's more room to go to the downside on the VIX, then the market is going to continue to bounce. But, this is not a time where you want to really go short on the VIX. Holding on to puts on the VIX is very, very difficult here. And the only thing that would cause the VIX to fall is if a lot of buyers step in on the market. And personally, we need to have a red day. We need to have a solid red day very, very soon. Either Wednesday or Thursday. I would be ridiculously shocked if we don't have a red day Wednesday or Thursday. Primarily because of the overextension out of Microsoft and the fact that the dollar is starting to bounce out of the lower level of the Bollinger Band. So right now, the dollar is not moving correlated. It's not moving inversely to the market. So generally, if the dollar is rising, then that's bearish for the market. But what we're seeing is as the dollar is rising, the market is also rising. So this is one of those times in history where the correlation is just not there. And the VIX, it should not be falling just yet. There should be a bit of a bounce. And then when we take a look at the bonds are showing a lot of strength. And of course, TLT is the equivalent basically to 20-year yields. It's also showing a lot of strength. So a lot of people are saying that the 20-year yields or 20-year bonds, TLT, is very correlated to the NASDAQ, which it is. And with the 20-year bonds bouncing like this, then that's going to cause the NASDAQ to rise as well. Now, that is possible, and that's 100% possible. But basically, the quicker we rise, the worse we see it is for the market. So, but overall, over the next 2 days, I'm expecting to get a solid, nice pullback in the market. But I really don't think that we're going to see, overall, the overall horizon. So based off of everything that we just saw, the overall horizon is we should be getting into leaps for longer term. Based off of just the fact that we had this move here, we should be getting into leaps for longer term. And this strength right here is not to be messed with. As we just saw in history, time and time again, it led to market bottoms or new highs. So this is absolutely insane, actually. So yeah, I'm just happy that we went and looked at this data. I'm going to do some more cleaning up on that data and see some more interesting things. I wanted to look at how the price acted a week afterward, 2 weeks afterward, a month afterward, etc., to get a bit more clarity. But yeah, immediately So, automatically I'm very biased. I think that we're going to end up having a red day either Wednesday or Thursday, which is tomorrow or Thursday. Both days Fed Powell is speaking. After that red day, we can easily just continue going up. So, yeah, what we have to do is continue to lean bearish, because if we're going to get a pullback, which we should, it would happen over the next 2 days, in my opinion, or by Friday. So by the next 3 days, we should have a pullback. But then the question is, are we going to buy the dip short term, or are we going to allow the market to pull back even more? But this strength today is really, really unprecedented. When we look at the NASDAQ cleared both trend lines today, and it's comfortably trading above both. So the level of support tomorrow is the crossing of both of the trend lines at 370.58, basically 370.38, 370.58, which coincides perfectly with the 7.86% fib, which is crazy. So a lot of bullish confluence overall for the market, and just be careful. Overall, right now is not really the time to start getting long. I would rather go long on pullbacks. And the IWM, last but not least, we're taking a look at the IWM. The IWM had a big pullback. It looks like it's trying to fill this gap here. When we do have a red day this week, this gap is going to get filled, and then it becomes a question of whether this second gap becomes filled at 165. So yeah, hope you guys enjoyed today's video, and I'm a bit lost for words. This is crazy strength that we're seeing in the market, and definitely historical stuff. All right, so I hope you guys enjoyed today's video. Please make sure to like, comment, subscribe, do all that good stuff. I will see you guys bright and early tomorrow morning. Thank you.